Welcome back. You're watching NDTV Profit. The Nifty is down 17 points, a 44% cut. The Sensex also facing a little bit of consolidation, not really big profit taking. Let's pull up the stock of Jubilant Foods. The stock saw a 10% move a day earlier after it came out with its third quarter earnings. We saw sales were higher by about 4%, but profits were down 31% from the same period a year ago. We have the management of Jubilant Food joining us now. We have Mr. Ajay Kaul, CEO of Jubilant FoodWorks, joining us from Delhi. Mr. Kaul, thank you so much for being with us on NDTV Profit. Now, your same-store sales were down about 3% from the same period a year ago. Your company would have faced the brunt of demonetization. How did you manage to see sales higher? Was it because digital modes of payments were present? What did you do to tackle this tough period during demonetization?
Look, demonetization, the demon of demonetization has impacted everybody as much as it has affected a consumer brand like ours. But while it came all of a sudden, we immediately did few things. Unlike many companies who clamped down on their advertising spends, some of them postponed their product launches, we made sure that we worked on 3-4 things. One, we did not push our advertising budgets into the next quarters. We actually went ahead and launched a product which turned out to be very good for us, which is Quattro Formaggi, along with a Choco Pizza, and they did exceedingly well. Consumers really accepted them as great products. Simultaneously, since a part of our business, which is the delivered business at home, which comes through the telephone, where acceptance of card at doorsteps is a challenge, we worked on some technological solutions quickly once that happened, and with the help of some of our partners, we are today able to offer even acceptance of card at the doorstep. So as a result of all these, we were able to still pull out a reasonably good quarter, far better than what probably the market was expecting. Having said that, the impact of demonetization is still there, and we believe that it will still take a few months before it kind of gets neutralized totally.
So for the next quarter, which is January to March, you expect same-store sales to be under pressure?
Most certainly, because the demonetization impact, as I said a little while back, is still there. We believe it will still take 2-3 months for it to get neutralized completely. In the interim, we are not getting bogged down by it. So all our, should I say, initiatives in the area of brand launches, in the area of putting money behind technology, online ordering, mobile first being a stated ambition of ours, because you probably are aware that during this period, while the business coming through the telephone orders actually fell remarkably, but it was to some extent compensated by our dine-in business, but more importantly, business which gets booked through the internet, through the online medium. Nearly 50% of all our delivery business is actually online today, and of that a substantial 56% comes through the mobile medium. So we have been diverting monies not only in building the right kind of platforms and the right kind of, you could call it, technological backbone, but also investing money in the social side, social media, and even the internet, to make sure that we are able to get more and more consumers. Without divulging too much information, I can tell you that during the course of the next week to 10 days, you will see a good initiative being launched by us for our mobile ordering. So investments on that front, investments on new product launches, investments towards commissioning our Greater Noida commissary, where we, in all we would be spending close to, I would say, 150 crores, including the land cost, to commission it. So somewhere in the month of March or April is where we are working towards commissioning that. That will set us up for all our store expansion programs probably until 2020 and so on. To cut a long story short, what I'm trying to say is that while these demonetization and all that may have had a bit of an impact on us, but our optimism about the business, the outlook towards the business, the consumption story which gets often talked about, all that we believe is still intact, and thereby investments on the brand, technology, people, building infrastructure, all that is still intact, making sure that 2020, 2022 we are all set for that, and as soon as the consumer sentiment improves a little bit, we believe we will hit the road running.
Right. Mr. Kaul, are you now going to look at the bottom line? This quarter you have closed a few stores. Are you going to rationalize your store expansion plan now? Are you keeping a tight belt on your costs? Because if you see visibility of people walking in and spending money on food getting lower, would you want to cut your costs?
Look, good question. We're going to attack this in three ways. One is, of course, the mantra is profitable growth, which means we still believe we have to grow, but we have, as you must have noticed, brought down our guidance for new store opening for this year to 115 stores for Domino's and probably around 12 to 15 stores for Dunkin', and which is far lower than, for example, 150 which we have been opening for the last 3 years in succession. The idea is that while the sentiment, which we believe should have started improving now based on the 7th pay commission fallout, the good monsoon and so on, but signs are still not visible and demonetization clearly hasn't helped. So we have brought it down to around 110 stores, and we believe, while we are in the midst of budgeting for next year, the numbers probably may work out in that zone or probably even lesser than that. So that is one part. So definite focus on profitable growth and being that much more sure that all the stores which we open are profitable and are giving us the paybacks within defined time periods. That is one. On the cost side, we have engaged with, while we deploy Six Sigma and we have been able to extract over the years some good, I would say cost savings and efficiencies and productivity gains, but we have now engaged with one top-notch, big consultant on a cost optimization exercise, and we believe significant gains will pour in over the next 12 months. On top of that, the GST, which hopefully should start then now from 1st of July, as even the finance minister is saying, again should give us substantial handsome gains over the next few years. So all this put together should have I would say a significant impact on our margins, both in absolute terms and most certainly in terms of percentage gains.
Mr. Kaul, if you could also just tell us about the cost focus that you're talking about. So the gross margins at Domino's would be around 76%, and the net EBITDA margins are around 30%. I'm not taking the Dunkin' Donuts impact. So if a lot of cost focus is given, at least 100 to 200 basis points can be increased over the next 2 years?
Look, without hazarding, any number here and not alluding to the number which you just mentioned, we believe that the impact of all of these, cost optimization exercise, GST as and when it comes, while there is a question mark there, but as and when it comes, is going to give us substantial gains, far more probably than even what you are suggesting.
Right. As far as price hikes are concerned, does that continue to be an important strategy for maintaining the margins, or now the focus will also be on cost, which means price hikes could be lower?
Look, not taking price increase is a part of our strategy now. We are clearly focused on value for both our Domino's as well as Dunkin' brand. For whatever reasons, we are quite prudent in terms of taking price increases in the recent past, but what we realize is that the consumer sentiment in a time when as it is, there is a tepid kind of an environment, too many price increases cannot be taken. So if you have seen in the Domino's side, for a good 1 year we did not take any price increase, and in the month of December when we did take a price, it was more a price rationalization than a price increase exercise, because we raised prices in a few, but we also brought down prices on few of our SKUs. Going forward, we would try not to take price increases as much as possible. Only when it becomes extremely crucial based on maybe food inflation and so on which may come in, we may be forced to take some price increases. And while we are at this subject, I do want to mention that being the largest player in the market, we are able to deploy, Six Sigma and work very closely with our, our business partners to keep food inflation at a certain respectable level. But cheese, or call it milk leading to cheese, as one of the key ingredients on the pizza, is clearly seeing a northward, tailwinds, which means they are clearly on the rise. Recently, Amul and some of the other leading players have actually increased the retail price also. So we believe that in the next 1-2 years, there will be pressure on the milk side and thereby on the cheese side. We will try to manage it without taking price increases. So price increase would be our last resort. I hope we are not going to take price increases frequently and hefty that too.
Right. Also, you just earlier mentioned about the changes in the targets of Domino's store opening, and also I was reading, some of the con call updates that you've closed down 6 stores which were non-profitable. It's the first time in the last 10 years where you're not sounding very aggressive about store opening. Any particular reason?
Look, it's not a question of us not sounding aggressive. It's a question of us having conviction that whatever stores we open have to be profitable stores, because we hold a responsibility towards, before anybody else, our shareholders, our board members, our investing community, and so on. And the moment we realize that the protracted period of consumer sentiment not moving up, and the FMCG space or the consumer space, how last 2 or 3 years now have been some of the worst years, since the demonetization exercise has not helped all this cause. So then we took some definite steps that probably the demon effect is going to last for another at least a quarter. So in the interim, we took stock of situation and said, let us bring down the forecast of or the guidance of our store opening, which we had said 130 earlier. We brought it down to around 110, and even going forward, we believe the numbers will be thereabouts or probably even lesser, without hazarding again a guess here. As far as store closures is concerned, and that's an interesting point you have raised. Look, there are some experiments which we also do. Being the market leader, we actually are trying to do things on a lot of axes. 3 out of the 6 stores which got closed were these metro stores in Mumbai, which means along the metro lines. Now it was an experiment. We realized that given the footfalls and given the transient, passenger flow there, 3 of those stores were not going to be profitable for a good long time. So we just shut them. And the other 3 out of these 6 clearly had some compelling reasons, where we knew that the visibility or the sight of, we had a clean sight on profits not coming for the next few years, so we closed them. It also is a message that while we may not have closed any stores in the last 10 years, and this may be the first lot, we won't shy from taking a hard look at our stores. And, given the last couple of years environment, there may be a few cases of our stores still sitting, which we may realize will not be profitable in the short run, so we may close them down. So we are not running away from that at all. Clearly the idea is that whatever we do, we bring in more profits, we give profitable growth, we manage costs better, or we reduce costs in some cases, we bring in efficiency and productivity, thereby engaging with even external consultants. And over and above all this, the GST as something which is hopefully going to come from 1st July is going to also lend its role in the EBITDA or the margin improvement. And in the meantime, honestly, if the consumer sentiment improves, which is what I would say our optimistic outlook is, that things will improve from here on, we believe the next few years are going to be excellent for Jubilant FoodWorks.
Mr. Kaul, thank you so much for taking out time for us. Always good to get in a perspective. That was a view coming in from Jubilant FoodWorks. They declared their numbers yesterday. The stock was up 10% post that. On that note, taking a break, coming back in 2 minutes, Saugata Bhattacharya of Axis Bank will join us on the other side.